We are all ready for the Tuesday edition of the Not Your Average Investor Show. Today, we are doing Not Your Average Insights, leading off with Jamie Dimon's most recent letter to investors. I'm your host, Pablo Gonzalez. With me, as always, trotting back in here like a triumphant American king from the north, the man that I affectionately like to call GC because of his genius concepts, because he knows how to generate cash flow, because he's a great co-host, and because his name is Gregg Cohen. Welcome back, GC.
Thank you very much. It's great to be here with you, buddy. It's great to be here with you all.
Yes. And with us, as always, our community manager, our marketing wizard, the one that brings us the moments that matter. And that's why we call her MTM. And because her name is Madison the Magnificent. Say hello, Madison.
Hi, everybody.
And GC, you might have been gone for a while, but what we like to tell people around here is that if they're listening on the podcast or watching on YouTube, that's awesome.
Yeah.
We love having them, and we love that our community's been.
But what should they do?
But they should go to nyais.com, show up live for one of these live shows, be part of the community, make a friend, and be part of what, GC?
The roll call, baby.
Roll call. We got Joe Bussey in the house saying hello, everybody. Welcome back, Joe. We got our usual leadoff hitter batting second today.
Listen, he is the leadoff hitter. Don't temper him now. He's the leadoff hitter. Sometimes he bats second, but he's the leadoff hitter. It's John Henning, of course.
There you go. Sometimes Ichiro bats second. I get it. We got Chris Gonzaga.
From the illustrious Hudson Valley.
From the illustrious Hudson Valley. We got the touchdown maker.
Shannon Baker.
We got the MVP of the community.
Lee Bishop.
We got Laura Colby.
Nune. Welcome to the party.
All right. We got our favorite name to pronounce, Aaron O'Neill.
Into the lights.
He steps in. Aaron, good to have you as well. We got our fiduciary financial analyst extraordinaire.
Oh, man. I was just listening to the show with Kelly Barenbaum. Kelly, you are amazing. Thank you so much for being on the show last Tuesday. I was just loving the content. It was funny. I was in my car and you see kind of like podcasts that come up and you look at the titles and you're like, which one am I going to show up for? And I forgot the title of the show. And I was just looking at it and I saw, why financial advisors don't recommend rental properties. I'm like, oh, I'm totally listening to that one. And it was our show. It was with Kelly. So thank you, Kelly.
All right. Awesome. Hervé Francois from Dirty Jersey saying, what up, JWB fam? Good to have you back in the house, Hervé. We got Billy Shields with his hi MTM, GC, and PG. Speaking in English today, Bill Shields.
Whoa, something's not right.
Yo no comprendo, brother. Yo no comprendo. We got the early bird checking in from Columbus, Ohio.
Dean Curry, you
know it. We got the first family of the Not Your Average Investor Show, the patriarch and matriarch, Ken and Carolyn Moline in the house. We salute you. Oh, man, it's so weird to do the roll call by myself.
I saw that. I saw you doing it. I was like, he needs me.
It's so weird. Oh, man. We got Gerald Schwartz back in the house. Gerald from Harold. Good to have you. Terry Ingram from Orlando, or what we like to call it, Jamlando. Terry got the JWB birthday card.
Oh, congratulations. Or happy birthday, Terry.
Aaron O'Neill telling us the score is 20 years.
What do you know? Jeez, you learn something new every day.
It felt like a score, all right? We got Denny Davis from Germany, Denny Davies with a Guten Tag, Nadeem Shah with his trademark good morning, good afternoon, JWB fam, hope all is well. We got the real estate maven of the mountains of Colorado, Leslie Wilson, greeting us from Denver, Joel Wixel.
New name.
Joe, welcome to the show from Santa Barbara, California. Ever been over there?
I have not.
Oh, man, Santa Barbara is gorgeous.
Yeah.
Yep. We got David Blattner in the house from the chilly, cloudy Massachusetts. Stevie B in the house. Who else we got in here? We got Big Papa's in the house.
Big Papa's here?
Big Papa's in the house. We love when he calls in Big Papa. Jay Cohen, Greg's dad. Who else did I miss? Who'd you just point out?
The ringmaster, Andrew Barnhill.
Andrew Barnhill in the house. All right. Good to have the roll call done. Glad I got my compadre over here to help me not feel like a weirdo when someone's just staring at me in a Zoom screen and I'm just yelling into a mic. GC, we got a big one.
Yeah.
We got a big one. So this is what happens every year. Jamie Dimon, who I think is the most famous bank president in the world at this point, right? He leads the world's biggest bank. He does an annual letter to shareholders every single year. Last year, he talked about this economic hurricane that was looming, right? So we've all been on edge. We've all been waiting for this report to come out. And it's a beast, right? Like we have it here, we're sharing it. Madison's going to share it in the chat, but like I'm scrolling through all of it. It's a big one. But there's a table of contents here, which is why we're proud of JP Morgan Chase, update on specific, blah, 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 company stuff. And then there's evaluating and managing economic and geopolitical risks ahead. It's super long. And so what did I do, GC?
Well, you made it super easy for everybody to understand. You bullet pointed it out, and then I think you worked a little wizardry into that.
Wrong. What I did was copy, paste it, upload it to ChatGPT, and ask it to summarize it for me.
That's pretty awesome.
So here we go. I'm going to summarize it for everybody, and then GC and I are going to talk about, because I sent him the whole thing without the cheat code. But here's what ChatGPT spit out about this in bullet points. Number one, the economy experienced several dramatic events in 2022, including the Ukraine war, 40-year inflation, 20% drop in stock markets, and a 50-year low in unemployment. Stuff we've been talking about, right?
Not normal times.
Yeah. Fiscal spending is surging. I'm going to give you some time to comment as I say this.
I'm ready to go. I haven't been in the show for 3 shows. Come on, man. Don't hold me back.
It's true. Fiscal spending is surging through the system, leading to extraordinary deficits and potential inflationary pressures. No surprise there. No, you're good. You're good. I like the commentary between things, right? So no surprise there. Spending is going bananas.
100%.
Quantitative tightening is following more than a decade of quantitative easing, which may lead to higher interest rates. Sounding pretty familiar. All the stuff we've been talking about on the show. Geopolitical tensions, particularly the war in Ukraine, adding material risks to the economy. More weird stuff. Managing risks is critical for real estate investors, and interest rates are extremely important in affecting all things economic. When analyzing stocks, many factors are considered, but interest rates and inflation have a significant impact on all. In a rising interest rate environment, investments with expected cash flows in the future may be affected, and carry trade parentheses, borrowing short and investing long, would be disappointed. Carry trade. I don't even know what that means, but I'm sure we're going to hit on this.
Yeah, quite honestly, I don't know what carry trade means either. I know what the effects of interest rates will do on cash flows, but carry trade, it's probably just lingo.
It's probably some robo lingo that ChatGPT threw in there. I mean, ChatGPT, I see you, ChatGPT. The company is prepared. This is JP Morgan Chase is prepared for potentially higher interest rates and longer inflation, right? That's what he's seeing. An inverted yield curve today may not predict a recession due to the impact of quantitative tightening. Higher interest rates may expose weaknesses in the economy, but the company is prepared for potential recession and related credit losses. There are risks and opportunities in restructuring of global economic relations, such as activities that create national security risks and the transition to a green economy, creating opportunities for companies. The company has formed a new security forum to assess the impact of ongoing threats to the company, its clients, and countries around the globe. And despite the risks, the positives ahead are huge, and America's GDP is expected to double in 20 years, lifting hundreds of millions of people out of poverty.
All right. That was the condensed version.
Quite the range, quite the range of emotions as I read all of that, right, GC? When you read it, I remember you shot back an email to me. What was your takeaway as you're reading all that stuff?
Well, it's interesting actually reading it and then knowing what Jamie Dimon wrote and then seeing what ChatGPT put in there. Most of that is the point he was trying to make, but not exactly, which is really interesting too. The overarching theme there after reading it was that, and what he meant from the tropicals, from being downgraded from a hurricane to a tropical storm.
Well, that was my language.
Yours? Oh, okay. So good, because it really is the essence of what he was trying to say. What he was saying is that the Fed has, in an attempt to rein in inflation, has raised interest rates at the fastest rate in 40 years. QT is a quantitative tightening, which is a term that it wasn't a term 10 years ago. It became a term when we did so much quantitative easing, when we increased the money supply so much in our economy. Now QT is the other side of that. Quantitative tightening is the removing of the money supply. And so that is in effect as well. And all of this was going along at a place where people were hoping that it would land softly. You've heard of this term, hopefully, of a soft landing. The Fed was hoping for a soft landing. They were hoping to increase the borrowing costs to people and to companies at a really, really high rate, but not send this into a recession. And what he was saying is that largely was the hope. We don't know if that was going to happen or not, but that was the hope that the market was feeling. And then Silicon Valley Bank went under. And it caused a very big kind of pivot in the thoughts and actions of investors, and as to whether or not this soft landing is really as likely as if a recession is more likely than it was before. And that's largely where people are going. Now, the interesting thing that he's talking about and what you're talking about as far as it being a hurricane and being downgraded to a tropical storm is we still have the same problems today that we had a month ago or 2 months ago before this disruption with Silicon Valley Bank going under and the bank run and all that stuff. The problem still persists. Inflation is still a very big problem. Mm-hmm. The Fed now cannot be as aggressive as they probably want in reining in inflation. They cannot be as aggressive when it comes to rate hikes or some of these other QT measures, because it's an even more delicate balance now. Yeah. And the risk of really turning this into a deep recession or creating chaos and fear in the minds of Americans is higher now. So what does that mean? We still have the same problem, but the Fed cannot use the tools as aggressively. It probably means that we are not going to have as many rate hikes, but we're still going to experience that pain. It's probably going to be a longer runway of inflation. It's probably going to be a longer runway of borrowing costs being higher, probably a longer runway of whatever type of recession we may or may not be heading into. Whereas before, I think the Fed was hoping to ramp this thing up with interest rates. Kind of, unfortunately, there would be some pain associated with that with job losses, but then we could kind of get right back into normalcy. To me, and what Jamie Dimon was talking about here is it's probably going to be a slower process. Inflation is probably going to be here with us for a longer, elevated inflation for a longer period of time. And it's probably not the way the Fed would have liked to do it, but it is probably unfortunately, the most prudent way to go about it now because of other forces like bank instability, like geopolitical challenges and whatnot.
That's an interesting summary by you, Human. I like the idea. I mean, it's neutral, right? But like what I'm holding on to here is that when you read through it, the biggest takeaway is this idea that while before, which makes sense to me, while before we were kind of like taking all these drastic measures that were moving things up in V shapes.
Right. Exactly.
Right. Like I remember when we were talking in COVID that people were talking about this like V-shaped recovery, right? Like that while we were applying these ideas of, no, we can just correct things really quickly. We got a little too close to the sun with that stuff. And the Fed was reminded that when it comes to government and when it comes to these like big institutional things, you're driving a cruise liner, you're not driving a speedboat. And what we are better off doing is kind of like changing things gradually, which means that the things that we as humans hope for, this like quick correction stuff, is probably not going to happen as such. And therefore, these things that we've seen coming will probably take a while to play out. Right? Like meaning inflation, meaning this recession that we see around the corner, which for the consumer means likely high interest rates for a sustained period, likely higher inflation, likely higher the inflation to last for a certain amount of time, which means that the high interest rates are going to stick around for a little while and continue to rise, maybe a little bit slower, and that the recovery from the recession that's going to hit will likely be a fast walk as opposed to like a sprint or whatever we're trying to do. Is that kind of what you're?
I think so. Yeah. I think one thing that I'll just say a little bit differently is I don't think the Fed had to realize that it is better to go slower. I think the Fed always knew that it was better to go slower, but the situation that we are in as an economy and largely how big of a miss it was by the Fed to think that inflation was transitory forced the hand of the Fed to do this sharp increase in interest rates. So they understood the risks that are associated with that. They understand that when you raise interest rates like that, that people who hold bonds that were purchased at very low yields become a lot less valuable when you raise interest rates 4.5% in a year. So they realize that they're stuck between a rock and a hard place. And so by doing what they're doing, they have been able to get inflation down somewhat. We're all happy about that. But there's still a lot more work to do. CPI is at 5%. Core CPI is still at 5.6%. Core CPI measures things that are less volatile. So it takes out food and energy prices. So those are still way higher than 2%. And the Fed would like to do more, but they can't. So I think the main point here, though, is instead of it being I think everybody is hoping that interest rates go down quicker. Yeah. Everybody's hoping that inflation just comes down, and whatever time frame you thought it was going to happen, add some time onto that, because there has to be a more conservative approach to bringing it down now.
As you were talking, GC, what hit me is this idea that in the last recession, it was pre-social media at scale. And what social media and the distribution of like headlines and all this stuff has done, it has created more exaggerated political actions.
Yeah.
So the Fed going through this, while they know what's better, right? Like why they instinctively understand that it's better to move slowly, nothing can protect them from being the first ever Fed in history to deal with the amount of pressure that they're dealing from in a public forum, unlike ever before. And therefore, this idea that we needed as a people to be reminded, chill, baby. Like, do not run, do not do this thing so quickly. Maybe it's a blessing in disguise, right? Like maybe this whole SVB crisis is kind of like the thing that maybe we didn't deserve, but the thing that we needed in order to just kind of like pull the brakes or something like that.
Let me give a slightly different take on it.
As you tend to do.
Inflation is like a sneaky thief.
Yeah.
People don't realize 5% inflation, that's 5% inflation just this year. If you can go back to compare what prices were for eggs and milk and gas and everything pre-pandemic, I mean, you're multiple years now. You're probably 15%, 20% higher across the board. Yeah. And that is like a tax on everybody. And the people who get affected the most are below middle income, and those who can't afford to do the same things that they otherwise were doing to take care of their families. And so really understanding how terrible high inflation that's 3 to 4 times higher than what the standard is really critical here. And I think the Fed does understand that. So I wouldn't say that this is a good thing, and I wouldn't say it's a blessing in disguise. I think getting inflation down to 2% or something well below 5% is really critical for us. And the fact that we are not able to do it as quickly as we otherwise would have is a problem. But it's a problem that we are going to deal with, and it is going to be one that we deal with as aggressively as we can, but it's going to be a slower haul is probably the way it's going to shake out. And that's the point that Jamie Dimon was making.
Cool. I guess I was being a little too optimistic there with the blessing in disguise. I get it.
Yeah, it's sneaky. It's a sneaky thief. That's what inflation is.
Sneaky thief. All right. I want to hit on like 2 more things specifically in this part where, first of all, our boy Hervé explained a carry trade is simply just borrowing money at a low interest rate and investing in an asset that pays a higher rate of return and therefore making money on the spread, right?
I got
so leverage. So I want to hit on these 3 bullet points that we summarized. Managing risks is critical for real estate investors, and interest rates are extremely important, affecting all things economic. When analyzing stocks, many factors are considered, but interest rates and inflation have significant impact on all. And in a rising interest rate environment, investments with expected cash flows in the future may be affected, and carry trade, borrowing short and investing long, could be disappointed. Let's start with this idea of managing risk being critical to real estate investors and interest rates extremely important in affecting all things economic. Yeah. How do you see managing risks for real estate investors? Like what is that advice?
Yeah, I mean, that's why I jumped into this game so strongly in 2006, is because I love the risk mitigation specifically for investing in real estate. And it's incredibly important beyond real estate. So I think the best way to mitigate risk is to have income coming in every single month. And there aren't a lot of assets that do that. So I think what you're going to see is that it's the same thing we've been saying for quite a long time now. Though in this type of economy, nothing has really changed as the game plan here, right? We are still facing the prospects of a recession. It may or may not be as deep as maybe it was. It may be longer than we originally thought, but it's the same thing. This is a time to be defensive. This is a time to mitigate risk and look for those assets that mitigate risk. How do you do that? Having income coming in on a monthly basis, that's a great way to mitigate risk, right? Having assets that historically have smaller ranges of variability, it's a great way to mitigate risk. turning turning assets into
income.
Thank you so much. Goodness.
You're back, baby.
Turn equity into income.
Too much poutine in the brain.
Yeah, right. I know. That was really good over there, by the way. Turn equity into income is important, right? Finding assets that can beat inflation, but that you don't have to take a lot of risk. So I think real estate plays single family rental property real estate plays perfectly into that. Interest rates are incredibly important to that. Cash flows, but you can still produce positive cash flows with interest rates that you have today. And again, being in Canada, it was funny. I was like, man.
Well, before, are you going to go straight into Canada? Are you going to move away from this? Because I just want to make a point.
Go for it.
Beyond single family home real estate, I think if we're talking about risk mitigation, I think the qualifier of workforce housing, single family real estate, I think really adds to that risk mitigation, right? Like investing in a necessity to me is risk mitigation, right? Like people will inevitably, if there's something we learned during COVID, is that while gas prices may have gone negative, home prices are a necessity. You don't need your car as much as you need shelter,
right, and
food, and toilet paper, right? But I don't know. I just wanted to add that qualifier, and then you can tell me all about your.
There's different ways to mitigate risk, even within a risk mitigated asset class like rental property. As that point is 100% accurate there.
Yeah.
Oh, I was just going to make the point about Canadians being super nice and helpful, and then also about interest rates and loans. Right now, we think interest rates are high because a year ago, 2 years ago, they were 4% or whatever. So we feel like they're high. But if you actually look at the data, go all the way back to the 70s, the average interest rate for a 30-year fixed loan is about 7.8%. So, and I lived through that in 2006 when I started to invest. My first properties had interest rates of 7, 7.5, 7.25. So historically speaking, we still are normal and below normal for interest rates.
Yep.
And the other thing that people just don't realize, and where the story of my Canadian friend comes into play, is I was driving home from the airport. We had somebody taking us. It was a van. I had my whole family there, and he was taking us home or taking us to the hotel. And he goes, "Hey, I got a little extra time. Do you want me to just take you through some neighborhoods in Vancouver on the way to your hotel?" And I'm like, "Sure, this is amazing." So I was like, what airport shuttle person does that? He's like, "I got a little extra time. Hey, let's just go do this." Right. And so as I was going through, we were talking about home values, and I was asking him about loans. And I was like, "Have you ever heard of a 30-year fixed rate loan in Canada, in Vancouver, to be able to buy a property?" He's like, "What? No. What? Where do you get that?" And I'm like, "Yeah." He's like, "Well, what would my interest rate have to be for that?" I said 6.5% or 6% or 7%, whatever it is. He goes, "What?" He goes, "You can do that for 30 years and get that low of an interest rate?" So it gives perspective. In other countries other than the United States, I think there's like one other country in Europe where you get 30-year fixed rate loans. You just don't get that in other countries as well. So the understanding of interest rates and debt and having perspective historically and in other countries is important when thinking that it's either too expensive or it's not.
Love that, man. Great perspective. It's so, when you're in Canada, it's so easy to think that you're in the United States, right? Because you speak kind of the same language, whatever, very similar traditions, but just crossing the border over changes the dynamics of like how wealth is made and why we're the land of opportunity and all that stuff, right? So that's cool, man. I want to hit on the next 2 points here. When analyzing stocks, many factors are considered, but interest rates and inflation have a significant impact on all. What do you take from that?
Well, there's significant correlation between stock market performance and recessions. And when interest rates go up as fast and as strong as they have over the last year, that has an effect on the bottom line for companies as well as individuals, but we're just focusing on companies here. And so if you're thinking largely that stock prices should be a factor of the bottom line, the earnings of a company, and you just had interest rates, the cost of the debt increase by 4 to 5% in the last year, run the numbers on these major organizations, these major companies, and you figure that now there are millions of dollars of additional cost that is just gone because their borrowing costs are a lot higher. Yep. And so you would think that and it does, of course, affect the earnings. It lowers the earnings. And you would think it should have some effect on what the stock price is. And so that's why when you have something like this happening with interest rates going so far high, so far up, that's going to have a negative effect on stock price. And then the overall performance of the S&P 500 during recessions is pretty clear too. Like the average drop during recessions is a 30% drop. We're not in a recession right now. So this is forward looking. So yes, I think that it's very easy to connect those dots that you are in for a rough ride with your money in the stock market over the next year. And even if it goes down or up or whatnot, I won't go so far as to saying I won't go down that route, but I think everybody agrees on variability is going to be way high because that's the nature of things in the market
100%.
and outside of the stock market.
Man, I just think of, I'm a small-time entrepreneur, right? And I was having this talk with my business coach a couple of weeks ago about, I'm freaking out, man. I think what we're talking about right now is this idea that the stock market is based on growth for companies, and big companies see the cost of, for the last 14 years, the cost of borrowing money to invest in growth has been very, very low, right?
Right.
So, that's definitely happening. I think on a micro level, as business owners, whether you're a giant company or a small company, I'm talking to my business coach and I'm just like, man, I'm really thinking about taking my foot off the gas on trying to grow and just like really going deep with my existing clients and just like making sure that everything is okay. And he's like, you won't be the first or last, business to think with upcoming hard times that you need to focus on just having a very, very like well-built ship instead of continuing to grow the size of the vessel.
Yep.
Right. So like, I think that micro decision that I'm making of like my strategy is a very human decision that if I'm CEO of GE, I'm thinking the same way.
100%.
So, pair both of those things with this idea of like how we value stocks and what it's going to do and interest rates and all this stuff. Like, I think it's pretty clear where, I don't know, man. I have my hunch of where the market's going to go, and it's not going to be as rosy as the last 10,
I'll just
14 years.
put it out there. I think the market is in for some tough times. We've been saying this for a long time, and that's why I think for those who have an idea, this is not a thought that you should just immediately pull everything out of the stock market and put it into a different asset class. But the thought should be put into everybody's mind here that you should look at your overall asset allocation. And if you have too much in your own decision that you have too much weight in the stock market and you want to reallocate, now is a great time to do it.
Yeah.
And to find another asset class that doesn't have those built-in variability and built-in risk factors, because usually just investors just have stocks and bonds in their portfolio. Both are struggling right now. And now is the time for a third seat at the table.
Cool. I want to bring up this last bullet point here. In a rising interest rate environment with expected cash flows in the future may be affected and carry trade could be disappointed. What do you say about that? This asset class, we are banking on that carry trade, right? What do you think about that?
Well, when I read that, Jamie Dimon was talking about those businesses that have a plan of either a project or their business or whatnot, where they're going to be borrowing in the future and having a certain expectation of what their earnings would be or their return on their investment would be in the future. And what the result of all of this in Jamie Dimon's mind is that you're going to see continued higher interest rates than what we were expecting before.
Yeah.
And so they're saying, those evaluations that companies are putting for what are they going to spend on borrowing costs in 2 years or 3 years, there's a big risk that that's off and that it's going to be less earnings, right? Higher borrowing costs.
Yeah.
So that's different than what we're talking about for our lovely asset class right here, because just like my Canadian friend was so fired up about having a 30-year fixed rate loan and was like, how do I sign up for one of those? Mm-hmm. And I was like, well, you can't, you got to live in America. We, for most of us, I would imagine who are listening right now, you live in America and you can get a 30-year fixed rate loan. So that removes this variable, that removes this interest rate risk in the future, and it holds your payment flat. While at the same time, if inflation is here longer and higher than we want, that has this effect on rents where it tends to increase rents.
And property prices too, right?
And property prices, holding everything else constant. So this is a great example of how to take advantage of debt and in an environment where interest rates do have variability going into the future. You lock yours in right now. If inflation is higher and longer and stronger than we want, tends to have a positive increase on the price of rent, and that affects more and more positive cash flow that comes to you over the years. as well as housing prices like we talked about.
Yeah, makes sense. Good explanation, man. What about what David Blattner says here? Will residents get squeezed by inflation and thus constrain rent increases or cause more residents to not be able to make their rent payments?
Well, all things held constant, if rents go too high and incomes don't keep up, then David's point is exactly right. But I think the question that we should be asking ourselves is, where are people going to live?
Yeah.
Right now, interest rates being high, like they are, especially relatively speaking, higher than what they were, that is making home buying largely unaffordable for a higher segment of the population across the country than it has been.
True story.
And in Jacksonville, we're blessed because we are an affordable market, but it still is causing housing to become more and more unaffordable. So, when home buying is not an alternative for folks because they don't have the down payment and they can't afford the monthly payment and they don't have the credit to do that, that pushes more demand for renting, which actually, continues to increase the prices of rents. So, the key here is long-term, we need to be focusing on how to raise median incomes, because if you just look at the dynamics right now, you have more demand coming to housing rentals, which will continue to at least buoy rent prices and probably increase them. And that all works, as long as overall people can afford it. It can be a beautiful thing if rents continue to go up and home prices continue to go up and median incomes go up. And that's one of the reasons we're so focused on our investment in downtown Jacksonville. We really believe that through our efforts and through the efforts of others who are early pioneers in the revitalization of downtown Jacksonville, that we can create this wonderful experience where we can be a change agent for median incomes to continue to rise. So that creates the foundation for rents to continue to rise and home prices continue to rise for all of you who own properties in the places that we put you, which are in those neighborhoods right around Jacksonville. So we got to focus on raising median incomes.
I love that, man. You painted this picture of what is obvious, what has become obvious to me over the years, that this is a super resilient asset class, right? Like the idea that if rents go up, it's because home prices are going up. And if like the population that generally rents in these homes gets priced out, there's going to be a whole nother population of people that are getting priced out of buying a home that are going to fill that in.
Yeah, that's interesting. Yeah.
The idea that the population that's renting in a nicer place, if the economy gets squeezed, they opt into, like this asset class.
I love how you keep bringing other ways of mitigating risk that we have specifically in the workforce housing model that we focus on. It's a great point, man.
I just really respect it. I think it's genius. You know, there was something else I was going to say. The other piece that I like is that, to me, Jacksonville as a city is kind of like this blue collar market city, right? Like our industries are that. Our industries are logistics and government and, healthcare that has a lot of blue collar workers. And, so the balance of it all to me is a really fascinating piece, still underpriced, still below the national median, and there's no national market, right? Like I see all these different signs and I see resiliency everywhere, specifically in this thing that you guys had the foresight to just like go all in on,
Yeah. Well, I'm kind of creating this construct in my mind based on our dialogue, right? Like, how do you mitigate risk in the overall marketplace? Well, single family rental properties is a great way to mitigate risk. But within single family rental properties, if you want to mitigate risk even more, focusing on workforce housing is a great way to mitigate risk even more. And then if you want to mitigate risk even more, finding a metro, a city or metropolitan statistical area, an MSA, that has significant population growth is a great way to mitigate risk even more, because that is built-in demand for housing. And so if you do all of those things, you're going to find yourself in a better risk mitigated place than the average investor who's just sitting and waiting for the S&P to go up or down, or waiting for the Fed to change interest rates this or that. You can really kind of insulate yourself from a lot of that brain damage.
That is the YouTube short from this episode.
All right.
Rita, letting you know. All right. Last thing I want to point out here is, actually, second to last thing I want to point out is David Bladner saying Gregg is a genius. Genius concepts, GC. That's what we're talking about. All right.
Thank you, but you apparently have never met a genius before.
The last point I think is this was a surprisingly optimistic thing, right? Like he downgraded this thing because of this last thing, despite the risks, right? I mean, he downgraded it because we're still in a good economy. There's still healthy, the consumer is still healthy jobs, higher wages, good credit, home values have risen over 10 years. So people have that baked in. The supply chain is recovering and business is generally healthy right now. So the point that is made here by our robo friend at the end, that despite the risks, the positives ahead are huge, and America's GDP is expected to double in 20 years, lifting hundreds of millions out of poverty, to me, I think is a really, really interesting point, which makes me think, okay, this means that I can count on us being in a better place tomorrow than today after a full market cycle, which makes me then think, okay, then my job right now is just to look at what is my best risk mitigated return over a full market cycle.
Gosh, you're a genius.
Genius. I know a genius.
Yeah, I mean, listen, like there's so much doom and gloom going on today. We live in a country which represents the most opportunity out of any country in the world. And I think a large piece of that is the access to smart debt as well. If you can understand how to access and take advantage of smart debt, mitigate risk, and hold on and just accumulate asset over asset over a full market cycle, it's hard to lose. And that's why I love investing in rental properties. You know, this is not get rich quick, but get rich over a full market cycle. That's what I bought into a long time ago. And I think most of us can. And, you know, there's so many positives about where we are right now. Like I was looking through the report a little bit more. Yes, the report. I need ChatGPT to help me, complete sentences here. But
careful what you wish for.
These are some of the things, right? Balance. This is according to Dimon. Balance sheets are in great shape for consumers. According to JP Morgan's analysis, they have 1.2 trillion more in excess cash in their checking accounts than they had before the pandemic. And so, after 10 years of home and stock price appreciation, he says, even if we go into a recession, consumers are in much better shape than they were during the great financial crisis. I remember what it was like in the great financial crisis. I was 23 years old. I had a lot of high interest debt on a lot of real estate projects. I'd never been through it before. The whole economy was not in a sound place. And we got through that. Like, we're going to be fine here, but I just challenge everybody to not think of yourself as a victim about to be victimized by this recession or by what interest rates are going to do. You have such an opportunity to make smart, wise decisions right now that will take you that will push you ahead and get you closer to your financial goals. But that commitment to thoughtful, prudent, long-term buy and hold has never been more valuable than it is right now.
Amen, brother.
Amen.
Stevie B, quick question. Is new investment in a solo K vehicle still a good idea these days?
Is a new investment in a solo K vehicle still a good idea these days?
So basically buying non-recourse loan inside your retirement, everything we just said, does it apply to that?
Well, let me get to that one first. So he's talking about a new investment in a solo K vehicle. A solo K is a type of qualified retirement plan. And it is a wonderful investment vehicle. You can contribute, upwards of like $50,000 a year into it. There's rules, so look into it. But if it's applicable for you, typically if you're a solo entrepreneur, it's definitely something to look into. I think that's a really wonderful thing. Now, what investments are you going to make in that? Well, buying rental properties can absolutely be a great investment. You can buy rental properties in your solo 401k without non-recourse debt.
Okay.
So you can buy them just using cash, right?
Yeah.
That might be a great way to diversify out of your S&P 500 holdings right now. Put that into this asset class, which is just housed in your solo 401k. And I think your question is, well, if you need to take out debt, does it make sense? That's where you need to sit down with my team or somebody else who's well-versed in non-recourse. Many times it's tough to make the cash flows work on non-recourse as it stands here right now because their interest rates are higher. Does that mean it's a bad idea to take out debt? Not necessarily, right? If you've got other income within your solo 401k to offset the slightly negative cash flow position for this asset, it might make sense to do that. Or maybe you bring over enough and you buy 3 properties in your solo 401k, and one of those is financed with non-recourse debt, and 2 are all cash positions. So it's not a yes or no answer, even when you get to the debt side, but definitely look into solo 401k. I think that's a wonderful vehicle, and cash purchases can absolutely be a way to win in your solo 401k with the current market conditions.
All right. I think this is a really good time to say it. If you want to have this conversation around the solo 401k, if you're, want to do all this, go to chatwithjwb.com and just hop on with JWB's team to talk about it, right? Like it's a non-pressure thing, or call your portfolio manager if you're a client. All right. Let's move on to the next story, GC. By the way, great discussion, man.
It's awesome, man. I love insights.
This is cool. This is a good one.
Can we just do this every week?
Yeah.
And then have Kelly on as well.
Yes-ish, yes-ish. Okay, so now what we teased at the beginning, disturbing trend happening right now, right? And it is Wall Street Journal article came out recently with this headline: more parents are moving in with adult children at younger ages, right? And basically what it said is 1 in 4 Americans aged 25 to 34 lived with parents or older relatives as of 2021. I think we're used to that, right? As a millennial, I'm used to getting dumped on for the idea that our generation has moved in with their parents more than others. Me, I turned 30 living with my parents because I was restarting a business and I was doing a couple of things, and I get along with my parents and it wasn't too bad. Now, here's the other really, really interesting thing. Richard Fry, a senior researcher at Pew, in 2021, 9% of multi-generational households were headed by a 25 to 34-year-old, up from 6% in 2001. Now, what that means is that the amount of folks that have moved in with their children have gone up by 50%.
Yeah.
Right. And it goes on to this. Yes, Madison, this is the second link. And it goes on to explain it as, hey, changing, there's a change in cultures. This is more acceptable. And also, real estate demands are showing that in 2022, 14% of all home buyers set up a multi-generational home, up from 11% in 2021, according to the National Association of Realtors, with like separate living areas for older parents. I think this paints a different picture than just like changing trends and whatever. This is from 2021. I'm curious to know what your thoughts are.
Yeah, here's my gut reaction, but then I also don't want to be just a typical American here too, right? Because I've lived in Spain, and living with your parents when you're age 30 is way normal. Like, especially when I lived in Spain, I mean, it was weird if you moved out of your house before then, right? So I think Americans have a slightly different viewpoint of it. But my gut reaction is that people in America don't tend to move back in with their folks unless economics are a very big part of it. And so if you think that way, which is a big part of it, then the economics for those who are investing later on in their life is just not working. It's not working as planned. And there's something that's just not allowing them to do what I would think most otherwise would do. I certainly don't think a 50% increase in the amount of households becoming multi-generational is something that all of a sudden Americans just want to do in mass. I think there's a lot of economics behind it. So it goes back to our previous, episodes that we've done when we talked about, is the typical stocks, bonds, 60-40 allocation working for folks? I think a very big part of what's going on here is that answer is no.
Agreed. So, listen, I would add to the discussion that people are not able to reach their goals is part of it. I think we've talked about this a lot. We're living longer, right? Yeah. Like, we need to think about it differently. It's one thing to not hit that number in the ING commercial that everybody walks around on, right? But it's another thing to like get to 68 and be like, well, crap, I think I'm going to live another 40 years and I only budgeted for 15. Yeah. Like healthcare costs have gone up, right? Like, this is the point in your life when that is happening, right? So like, I agree with you that it's a, without getting too specific, whether it's a 60-40 portfolio or the 80-20 or whatever strategy that this generation has had this generation that's moving into retirement, right? Like the younger boomers has had coming up to these points in life, the game has changed. They're living longer, healthcare costs are higher. Real estate has indefinitely gone up in a different way than ever after 2001, right? Like all these different things are compiling to this idea that I think bodes to what we've been talking about. You need different strategies to get there, whether it is this idea of real estate and cash flow coming from that, or a different allocation between stocks and bonds, or whatever you're doing. It doesn't seem to be working when a 50% increase of people are moving in with their kids later in life.
I agree with you, especially on the 50% number. I think that's the biggest thing. Like something's not working there.
Yeah.
But do you think that people are sort of setting up their families or their goals to maybe go more towards how we do it in other countries, which is to take care of aging parents more personally? Do you think that there's a trend of that happening in this country as well?
I would say that plays into it as well.
Maybe.
Right? Like, listen, man, speaking as someone, you mentioned the Spanish culture, right?
Right.
Like,
yeah.
That is my culture, right? You do the 23andMe, it's all, like Southern Spain, 97%. The idea of ever putting my mom in a home, if I could afford to her like live with us, or her condition hasn't deteriorated to the point where she needs help, is something that I would save as the last recourse.
Yeah.
Right. At the same time, man, it's hard to imagine the idea that my grandfather lived to be pretty old, my grandparents lived to be pretty old. If they can afford it, they rather live by themselves.
Yeah. Yeah. There's a lot of that too. Yeah.
It is a generational thing of like, yeah, this is very acceptable, but I don't think that you do this unless you have to do this.
Certainly not to the degree of 50%.
Not to the degree of 50%. And just, I just think from their own personal preference, independence is preferred.
Yeah. I think for some, I think for others, maybe not.
Yeah.
Who knows? But this type of movement there is certainly reflective of, listen, people move in with each other when they don't have enough money to support themselves. I mean, there's something going on there. And you'd think like if this just happened after the Great Recession, then you'd say, oh, well, you know what, this is a momentary thing. It's just because there was a lot of loss of wealth. But and the Great Recession was 15 years ago. We've largely had a great run in most asset classes since then. So the returns overall largely have been there, but somehow it's not affecting quality of life when it comes to that decision.
Yeah, agreed. And I go back to that statistic that you like to bring up, this idea that when you query the American public, the number one thing that they believe that creates wealth is real estate. And yet when you query the American public, only a fifth of them, it's the fifth most popular thing to hold in your portfolio.
You are just always good with the details.
Yeah. So anyways, I don't think that they're wrong. Right.
Right.
And I think that what's stopping people is like the misunderstanding of this asset class and the need for more providers like JWB that make it easy for somebody like myself to get into it.
Love that, man.
Yeah.
Love that. Happy to help.
You ready to get real self-indulgent with our last take here?
What are we going to do?
We're going to talk about the NFL draft. We're going to talk about the NFL draft. I'm going to keep this short because we're almost done here. But we talk about quarterback arm strength all the time. I am an NFL quarterback evaluation geek. Right now, the top quarterbacks in the draft are a couple of guys called Bryce Young and CJ Stroud, right? Like Bryce Young is a guy that has won a ton of games in Alabama, isn't the right size, but he's a little shorter than people want him to be, but he makes great decisions. He's a great leader. He throws really, really accurately. This guy at Ohio State, CJ Stroud, has again all the accuracy, the arm strength, all the tangibles. And you look way down the draft board, right? At number 5 is a guy called Anthony Richardson,
who we know well.
Quarterback of our beloved Florida Gators. This dude is 6'4". He runs a 40-yard dash faster than a lot of wide receivers. He's the quintessential athlete. He's got a howitzer for an arm.
Amazing.
That thing just leaves his hand and looks like no effort, and it goes at 100 miles an hour. beautiful spiral. And all the talk of the draft is this idea that who's going to take this guy number one, right? Like all these like NFL scouts are falling in love with this dude's unbelievable physical activity because, physical ability because it jumps off the charts. And what do you think about that, GC, as somebody who's watched him play?
I think I watched every minute of every game this past season, which was his only season starting for a full season. And I mean, I'm diehard Gators.
Yeah. It's
not normal for us to have a top 5 projected draft pick
in
the first round, especially not a quarterback.
Yeah.
Right. I mean, Tim Tebow got drafted like 26th or 29th.
Yeah.
And
he was questionable first round.
Yeah. So this is not normal. And I'm just saying to myself, there's no way I draft him. There's no way I draft him number 1. No way I draft him number 2, 3, 4, 5.
Yeah. Because we've seen him gun it to somebody that's too short, make bad decisions. Like, well, he can save it with his leg, do all that. Now, how that relates to rental property investing is something that we talk about all the time.
We do.
Right? We talk about the 5 profit centers. Yeah, Sergio Prieto, go Gators. He totally agrees.
Yeah.
As people that have watched it. It's the same feeling of us talking about the 5 profit centers, right? Everybody, when you first talk to them about rental property investing, it's like, what's my cash on cash return?
Right.
How much cash flow do I get every single month? I need to maximize that cash flow. When we're out here saying it's not just about maximizing cash flow. It's about looking at an asset class in its entirety. It's about the fact that when we show these breakdowns, home price appreciation ends up being the large majority of the wealth that you are going to build. And yet people want to draft this dude overall because they think that he can throw a football through a brick wall.
Right.
Even though when you watch the games, he's not winning them. He's not making good decisions and he's not putting his team in the best place to win, the same way that rental property investors are falling in love with like an extra $100 a month that is going to completely not move the needle for them.
So well said. It's like, what was his 40 time right here? It was like a 4.440.
4.43.
I mean, his stats are off the chart. Think about that. All of his stats. He's 6'4", ran a 4.43 40-yard dash. He's 244 pounds. I don't know what the other stats are here, but think about that as all of the metrics on your deal evaluation. And it's the thing that all NFL scouts right now are looking at. They're just looking at a deal evaluation for all of these guys. And they're saying, oh, I'm totally going with AR because his deal evaluation looks the best on paper, but that deal evaluation doesn't tell the full story, just like a property evaluation largely doesn't tell the full story of all 5 profit centers. And, what did the deal evaluation for Tom Brady look like in the scouting combine? Right?
Or the guy from San Francisco last year.
Yeah.
Brock Purdy.
Yeah.
Mr. Irrelevant.
Yeah, exactly. Mr. Irrelevant, the last guy drafted, but he's been a total winner and brought San Francisco to the championship game there. So, it is so relevant. I'm glad you brought it up. And I wish our beloved AR for our beloved Gators wasn't the poster child of this.
Hope we're wrong.
I hope we're wrong.
I hope a coach can really sit there and groom him and whatever. But I think these guys are buying. A declining market, cash flow, like cash flow positive thing day one that you're going to feel real good about. And in 25 years, you're going to wish you hadn't made that career move as a scout, while the person that drafts the dude that's really accurate, the guy that has great home price appreciation 20 years later is going to look like the genius.
I think so. I think so. I haven't found one Gator fan who thinks he should be drafted in the top 5.
Have you?
Yeah. In my network, everybody's like, I'm glad my team's not thinking about drafting it.
It blows my mind, man, because I've gotten into our argument with my friends, and like, I don't want to relive those arguments. But yeah, there is a couple folks out there that are just like, yeah, man, like they can just teach this thing, just like give me that cash flow today. Yeah,
well said, brother. Well said. But I hope we're wrong on AR's behalf.
All right. Thank you for indulging me in that. We've been wanting to have like a contextual, topical thing. Sucks that it's our guy, and we're not sure about him. We hope we're wrong, just like we hope that you're making the right decisions out there in real estate. And this was another Not Your Average Insights, man.
Love it, man.
We had the ticker start at like low 40s. It raised up beyond 60 during that Jamie Dimon discussion.
Nice.
Meaning people are opting in, seeing it live. Couldn't do it without this great, just discourse in the chat. Shannon Baker, touchdown maker, in there was throwing some dimes. Great stuff by the ringmaster and Bill Shields and Chris Gonzaga and Sergio Preta and everybody at Denny out there, like Ken Moline adding value to the chat. I just never take it for granted that we have this awesome community that comes here and will engage in these discussions with us. I'm just super, super grateful for it. If you're listening on the podcast, come to one of these days, right? Go to nyais.com and show up.
I love it. I love it. And I definitely don't take it for granted now, considering I've missed it for the last 3 weeks. So thank you guys for welcoming me back with open arms. I missed you, and I just love what we have here. So thank you guys for making this awesome and the best part of our working day for sure. Yeah. And we'll catch you on Thursday.
I don't take for granted you being here for the roll call, bro.
Yeah.
I've learned that one. But listen, if you want to, if you don't want to draft that lemon that's going to cause you your career, don't fall in love with quarterback arm strength. Don't fall in love with cash flow. Listen to Jamie Dimon. In a full market cycle, prosperity is going to happen. So be smart, and whatever you do, don't be average.